Right now, we're joined by Goldman Sachs Vice Chairman Rob Kaplan, who's also a former Dallas Fed president. And Rob, what do you think about that? Just Steve's point in particular about the Fed's mortgage portfolio, what you think should be done with it.
Yeah, well, several years ago, when the Fed was buying treasuries and mortgage-backed securities, we discussed back then the Fed's footprint in the mortgage market was getting very, very large, and it was becoming a big factor. And I think some of us felt like that was probably not appropriate, and maybe the Treasury would be a better place to manage that mortgage portfolio, and the Fed portfolio should ideally be mainly treasuries. And so, I follow what Steve is saying. I think mortgage rates are a factor, but they're a piece of a bigger puzzle. There's local regulation, permitting, cost of materials, availability of labor. That's been an issue home builders tell me about in terms of building homes. There's an affordability issue. That's where the mortgage rate comes in. I think we need to look at all these things because housing is such a big part of the economy. When it's this sluggish, it creates a headwind for the economy. And so it's worth doing a full review of all these factors.
In other words, pointing out that the Fed alone can't fix what's going on with housing at the moment? That's right.
It is a piece of the puzzle. And as Steve said, maybe they could do something with mortgage maturities or stop the runoff. But, yeah, it's only a piece of the puzzle. You got to look at all these factors.
Let's talk about what you think will happen today. Are you in the pretty dominant camp of 25 basis point cut expected from the FOMC?
Yes, I am. I think they'll cut 25. And I think in the press conference, Jay Powell will have to address two issues. One, he's going to need to leave the door open to doing further cuts, but he won't make a commitment to it. But the other thing he's going to have to deal with, there's a summary of economic projections that he'll have to speak to. And my guess is you're going to see a pretty wide divergence in this summary of economic projections. You'll see some people who think that beyond September, the Fed shouldn't cut any further. You'll see others who think we should cut 3 times this year. And I would guess the median will be closer to 2 than 3. I think the market is pricing in closer to 3. So he'll have to speak to that.
Mm-hmm. Rob, the idea of where the economy stands right now, I'm shocked on a daily basis, kind of the wide variety of views that we hear from people thinking that, there's no question you should begin these rate cuts. You should have done it months ago. You should be doing 50 basis points today. This economy's in trouble. This labor market's in trouble. And then the other side of things where people are, I'm not even sure we should cut at all because things look pretty good if you account for some demographic changes, if you're looking at corporate earnings, if you're looking at retail sales, if you're looking at so many other factors. Where do you come down on it as somebody who was in that room for a long time with the FOMC meeting? And how does it play out, particularly with the amount of pressure that is coming politically at this point for the Fed to go ahead and cut by more?
And I deal with these cross currents every day in business. And so on the negative side, tariffs, whatever you think about them, in the short run, they slow growth. In the longer run, if they encourage reshoring to the United States, they can help improve growth. But in the short run, everything we can see, they create a headwind for growth. Also, limiting immigration, the deportations, very low labor force growth is also a headwind. So that's creating part of the weakness you're seeing. On the other hand, if you look out over the next 2 or 3 years, and this is what the stock market is pricing in, you've got an AI data center power boom. You've got tax incentives coming with the new tax bill, tax on tips, tax on overtime, accelerated depreciation. You've got regulatory relief coming. It just takes a little time. And yeah, you even have some potential rate cuts. You know, rates are going to go down, question of how much. And so the market's pricing in those tailwinds. The economy is reflecting those headwinds. I think eventually both are going to converge, but it's understandable why there's disagreement in that those tailwinds haven't taken hold yet, but they probably will. And that's why you've got a lot of this debate.
In your role now at Goldman Sachs and the business that you see, do you think that Or where do you think the neutral rate is for the Fed funds rate? What does the market need? What does business need? What does the economy need?
My own view, and this is imprecise estimate, but my own view is the neutral rate today is 2 3/4 inflation. If you think inflation's higher, then use a higher number, but I use 2 3/4 inflation plus 0.75%. I think it's probably the real Fed funds rate, the real neutral Fed funds rate. That gets you to 3.5%. I think it's hard for me to argue it should be lower than that. So at 4 1/4, 4.5, Fed doesn't have that much room. It's got 75 to 100 basis points. You've heard me say before, a year ago, it had 175 to 200 basis points. So these were easier decisions. And so the reason I think the Fed will take it one meeting at a time, will be careful about committing, is one, these cross currents, the fact inflation is running well above target, and also the fact I think with inflation above target, you could argue being somewhat restrictive, but I think it's harder to argue you want to get all the way down to neutral. And that tells you the Fed has about maybe 50 to 75 basis points of rate cuts to work with, unless the economy weakens a lot or inflation improves meaningfully from where we are.
All right, that explains a lot. That would be a good reason not to go 50 basis points today.
Right, go 100, just like he said. Right, just let's get there.
Today?
Let's just get there. If you get don't give me like a little half a shot of penicillin.
It's rationing.
Knock it out.
It's rationing.
Knock it out, Robert.
So the other comment is in the S&P, what'll be awkward is since the June meeting where the median was 2, I don't think the views of the labor market, they may weaken a little bit in the S&P, but maybe not a lot weaker. The inflation outlook has gotten a little bit worse. And so that's another reason why they're going to be more cautious than people might like.
Robert, if there was ever a time where they did 50 or whatever, and people said, this would be the time. What do they know that we don't know? Because there is some consternation about, I think, the labor market right now. And we don't really know what the participation rate is. And some people have said it could be as high as 5. I mean, if they did 50, people would think they absolutely knew something bad was underneath, I think.
Possibly, but I think on this one, I was an advocate, as you know, of 50 a year ago. I felt they ought to get a move on, and they were just too high and ought to get moving. I don't feel that way now. And the issue on the labor market, the labor market is subject to self-help in that we could do more to ramp up legal immigration. We could clarify the status. It's a controversial subject, but we could clarify the status on 10 to 15 million workers who are law-abiding, been in the workforce for many years. We're not doing that right now, and it's creating some headwind for labor force availability and for the economy.